Good evening and welcome to another episode of TaxSnax from Old Square Tax Chambers. This is a special episode, and that's why I'm saying good evening, because we are here on the evening of Rachel Reeves' first Labour budget for 14 years to take you through some of what's come out of that from a tax perspective. Now, there is an awful lot in this from a tax perspective, so we are sort of in a do our best type situation. So what we mean by that is this isn't advice, this is just us commenting on some of the provisions that it looks like are going to come in and some of the proposals that are being discussed, which we will obviously discuss in a lot more detail. I think we're going to have a bit of a TaxSnax series on this budget because there is so much in it, but probably for about the next decade of all of our careers as well, I would have thought. So yes, plenty in there. So today you have me, Harriet Brown, Mary Ashley, Ben Symons, Shane O'Driscoll and Shanzé Shah. And I think because there is a lot, we're going to get this kicked off. And I'm just trying to remember who was going to speak first. So first of all, I think we have Mary, who's going to talk to us about the inheritance tax changes that are proposed for agricultural and business property relief.
Yep. So I'm just going to briefly look at the changes that they've announced for APR and BPR. I think these were changes which were talked about, sort of changes around BPR and APR, I think have been talked about for many, many years. So we can't be too surprised that something's happened. I think we can take some solace in the fact that it's not been entirely abolished. So we can be pleased about that, but they have limited it to quite a great extent. So we'll just need to bear these rules in mind going forwards and take that into account as we advise people over the next couple years and beyond. So I think the first reform that is going to be coming
Sorry,
in.
Mary, just to jump in there, you have just reminded me that BPR, changes to BPR, is a perennial favourite for clients turning up at the last minute before a budget wanting to sell something or transfer something. And maybe we won't see that for a few years now because we've had the change.
Yep, that's true. I had quite a lot of people asking me what I thought was going to happen, and I said if only I had a crystal ball. And I didn't predict this. I will say that is for sure. I didn't predict these exact changes. But I did say there might be something. So I think the first thing we can note is that from next tax year, so 6 April 2025, there's going to be a slight extension to the existing scope of APR, and that is just to include land that is managed under an environmental agreement with the UK government or on behalf of it. So I think we can, for those people who do have these circumstances, this will be a welcomed addition. And the major changes, however, will be coming in from 6 April 2026, at which point they're going to be introducing a £1 million allowance for individuals after then. So what will be limited going forward is those assets which qualify for either 100% BPR or APR will now be subject to a £1 million allowance, with all assets that would otherwise be subject to a 100% BPR or APR allowance limited to only 50% beyond that amount. Now, it applies to your combined amount of APR and BPR, meaning you don't have two separate £1 million allowances, you just have one £1 million allowance. And where you do have APR revolt property as well as business property, relief property, it will apply proportionately across those two. Now, there are assets which are currently benefiting from 50% relief, and they will not come into that allowance. So that means that anything that's subject to 50% relief, there's no limit on that. That will apply across the board. In terms of having any unused allowance, the government has made clear that it will be non-transferable. So you will want to plan around using it up entirely on your death if that's something that needs to be considered. Now, it will apply to property that is in your estate on death, to failed pets, and to chargeable lifetime transfers. Now, there's going to be specific rules which will be introduced to consider how it is going to apply to trusts going forwards. For trusts that have already been created and property that has been transferred into them, the idea so far is that they will each have their own £1 million allowance. However, going forwards, for any trust set up as of today and onwards, they're going to try and come up with a provision to ensure that the settler, if they do set up multiple trusts going forwards, they don't get an £1 million allowance in each one. So there will be anti-forestalling measures to bear in mind. And so it's going to be sort of limiting to some extent.
And presumably that sort of drafting should be relatively straightforward, because there's already things in the Inheritance Tax Act which do a similar thing, i.e. stop somebody having multiple allowances across a number of trusts, for example.
Exactly. So I imagine it'll just similarly follow those sorts of rules. And then the final sort of big change that they've made is that they're going to reduce the rate of BPR available from 100% to 50% for all circumstances for shares designated as not listed on the markets of a major stock exchange. So unless anyone has anything else they want to add about APR or BPR, I think we're going to be handing it over to Ben, who's going to talk about some of the pension changes that they brought up.
So that's fantastic, thank you. So Ben, we've got a fair few bits and pieces on pensions, haven't we? Not necessarily anything major in one. Well, we have one major one, I think, but then we've got sort of lots of other little bits around the edges as well, which could really impact certain people.
Yeah, that's right, Harriet. The biggest change in relation to pension taxation is that from 6 April 2027, most unused pension funds and death benefit payments that are payable when a person passes away from their pension fund, or that are death benefit payments into a pension fund when a taxpayer passes away, will be brought into their estate for inheritance tax purposes. That is a major change from the current regime, where lump sum death benefits are not subject to inheritance tax. In respect of this change, the usual exemptions will apply, the spousal exemption will apply. So there are some exemptions. Other matters to note in relation to pensions, there will be a reduction in the tax-free overseas transfer of pensions to the EU and Gibraltar from the UK. From 30 October 2024, the transfer of UK pensions to QROP schemes in the EU and Gibraltar will be subject to the overseas transfer charge to prevent taxpayers getting a double tax-free pension allowance. Another change is that the government will require pension scheme administrators to be resident in the UK from 6 April 2026. And a further change to the pension regime is that the government will maintain the state pension triple lock for the duration of this parliament. The basic and state pensions will therefore increase by 4.1% for the 2026 tax year. And another pension change to the pension taxation regime is that the government will bring in line conditions for an overseas pension scheme and a recognised overseas pension scheme in the EEA with conditions for schemes in the rest of the world. Essentially, the conditions for an overseas pension scheme and a recognised overseas pension scheme will be far less generous in the EEA than they were previously. And yeah, those are the changes to the pension taxation regime.
I think, I'll go next on some of the changes that have been brought in for alternative finance changes. This is a change that follows a consultation on this tax simplification of alternative finance. And if anything, I suppose it's pro-taxpayer. So before there was a certain misalignment between how ATED or annual tax on envelope dwellings functioned when there was an individual as a result of certain alternative finance arrangements. And they have basically simplified the legislation to make it clear that individuals purchasing property through alternative finance arrangements will have certainty that the ATED charges do not arise when alternative finance is used, and that's coming in effective today.
Okay, I think I'm next.
Sorry, Shane, I was just going to ask you about the diminishing share ownership refinancing arrangements. Is that what we're talking about here, or is that the other part of it?
That may be the other part of it, which I haven't looked into as yet.
Yes, as I said, I think I was saying to Mary just before we started, they seem to be still adding to the documents published with the budget now, so there's an awful lot out there. This just relates to some changes to the Income Tax Act 2007 in relation to diminishing shared ownership arrangements. So I think this is effectively to ensure the capture of income arising to the financier of these arrangements, so that it is accurately captured in a similar way to the way in which interest would be captured, which, if I've got that right, and I'm not 100% sure that I have, but if I've got that right, I think that is sort of a change more for we've not quite got it right yet. This is what we're aiming at, as opposed to anything else. So yes, Shanzé, you are going to talk about the ORIP. I think that's right, isn't it? Brilliant.
Yes, that's correct. So this can be brief. The government is just confirming that the ORIP rules will be abolished in respect of any income arising from 31st December 2024. And that's they were sort of a short-term unilateral measure, which was, aimed at decentralizing large sort of multinational enterprises from holding intangible property in a low tax jurisdiction if that property was then being used to generate income in the UK. But now the legislation is not required anymore because the OECD and G20 inclusive framework, Pillar 2, global, it's very wordy, global minimum tax will comprehensively...
Just call it Pillar 2, Shanzé, everyone else does.
Yeah, I think that makes it way easier to follow. That does discourage these sort of MENEs to not go through these arrangements. But what it's doing is the legislation that is being repealed is Chapter 2A of Part 5 of the Income Tax Act 2005. And as I said, that this will be happening from, so it'll be abolished following the end of this year. I think there's not much more to say on that.
No, and of course, yes, as you say, this is a result of the fact that we now have legislation that deals with Pillar 2, and indeed one of the things I'm going to talk about a little bit later is the fact that we haven't managed to get our Pillar 2 or indeed our Pillar 1 legislation right yet. So there's some amendments to that, but that is not next on the list. Next on the list we have got CGT. Shane, back to you.
Yeah, so quite a few changes in this area, and quite a few let's say material changes to the rates. So just going through the headline figures, so excluding non-residential and carried interest, so the rates will move from 10% to 18%, and from 20% to 24% for capital gains. Business asset disposal relief, we're keeping the £1 million limit. There was a lot of speculation prior to the budget that was going to be reduced. But what has happened, or what will happen, is the 10% rate that you get for your BADR relief will rise to 14% on the 6th of April 2025, and then a further 4% rise up to 18% from the 6th of April 2026. So I think a clear indication they want to sort of phase that out, but giving a bit of time before they actually hit that position of it being entirely phased out.
It's not a particularly generous phasing, is it?
No, certainly not. Certainly not. But yeah, I think as was mentioned at the start, there may be another flurry of activity to try and get certain transactions across the line prior to some of those dates over the coming time in order to crystallize certain gains for.
Yeah, so your first one is 6th of April next year, and your next one is the following year. So
correct.
yeah,
Yeah.
if you miss 6th of April next year, try to make sure you 7th of April get started so that you're not doing it all at the last minute.
That's sage advice as always, Harriet. The other change, so they announced that investors' relief, the lifetime limit will be reduced to 1 million, and that will be on. It'll apply to qualifying disposals made on or after the 30th of October, so on or after today. They've also indicated that there will be it will apply to certain disposals made before the 30th of October. So I suspect some form of forestalling provisions, but I have to admit I haven't gone through all of the draft legislation as yet to be able to provide any more detail on that.
So again, just to give a little bit of context there, the part of the draft clauses that have been published in relation to non-UK domiciled individuals extend to 130 pages, and that's just one part of what we've been looking at since, or what was it? We should probably finish speaking about 115, something like that. So yeah, no shame there, and Shane not being absolutely certain that you've got all the way through the legislation, because you would be a champion speed reader if you had.
You stole the line I was going to use when I talk later on about that. I was going to highlight the 130 pages.
I'm so sorry. I'm so sorry.
It's quite all right. Quite all right.
Use it again. It's a point worth making twice.
Yeah, so I think that's they were the main points really I wanted to hit on at this bit, unless anyone else has anything to add.
So I think that brings us round to me, and I just wanted to speak briefly about some of the I've sort of in my mind I've mentally categorized them as international changes. We've got a few little bits and pieces, some out for consultation, some more firmed up than that, in relation to sort of the international tax landscape. So obviously, Ben, you've spoken about the pensions ones, and I'm not going to repeat those now. But we've got some bits and pieces in relation to Pillar 1 and Pillar 2. And the other one that we've got that I just wanted to mention was, and I'm just trying to find it. Yeah, I think we've got a consultation, is it, on tackling offshore tax non-compliance. Now this refers to primarily, I think, CRS, and it's proposing some changes. So CRS is the regime is the international automatic reporting regime. One of the things that the consultation paper says is challenges to compliance remain, including on offshore tax. Offshore tax affairs are often complex, and errors can lead to taxpayers declaring less tax than they should. Presumably, if it's a matter of complexity, they can also lead to taxpayers declaring more tax, but no one ever mentions that aspect of it. A minority also seek to reduce their tax bill deliberately by hiding their income and assets offshore. And they then go on to say it is inherently difficult to accurately assess the amount of tax that is incorrectly paid in the UK on assets and income held in countries outside the UK. They then talk about some experimental statistics which were I don't know what an experimental statistic is. I love the idea of it though, because I mean statistics are inherently untrustworthy, as we're told, lies, damn lies, and statistics. But experimental statistics, I think that's what most people might call a guess. I don't know. I just don't know. But they estimated that 4% of UK resident individuals covered by automatic exchange of information underdeclared in 2018 and 2019, and in absolute terms that represented around 0.3 billion pounds. So not a long way towards the black hole, but you know, something. Every little helps. Have the check down the back of the sofas. So what when one digs through all the waffle, what one gets is in essence this. Sorry, I'm going to tell you in a moment. In essence, what we get. So we get assisting compliance and preventing mistakes using a data-led approach. We have responding appropriately to offshore tax non-compliance and undertaking global enforcement activity. They then go on to say, going further to address the remaining challenges on offshore tax non-compliance. This government is committed to going further to close the offshore tax gap. And so they this is the additional resources that they've talked about, which I think primarily seems to be aimed at tackling serious offshore non-compliance by wealthy customers, corporates they control and other connected entities. So we've got a more coordinated approach, but what's more interesting is the legislative changes. We've got what's referred to as a suite of changes, which include extending CARF, that's the crypto asset reporting framework, to UK crypto asset users in order to make it easier for HMRC to systematically collect this information. So that is effectively what is an international regime is going to apply, I think, domestically as well. We have got making changes to the penalty regime for failure to report CRS data to ensure reporting institutions are meeting their obligations. Now, I love CRS penalties because CRS penalties are pretty small. And one of the things that I've been saying from the beginning of CRS, because I am that old, I've been around since before CRS, was the penalties are going to start out small, but they're going to get bigger. And one lovely, not by the UK, not by HMRC, but by a foreign revenue authority, one lovely thing that I have seen is when an institution had a problem with its software and it couldn't get all of its CRS stuff in, and it had reporting responsibilities for hundreds of trusts. It was a trust company. And I think they phoned their accountants and said, what are we going to do? We're not going to get this down by midnight. And the accountants said, that's all right. It's a 500 quid penalty. Anyway, they were given a 500 quid penalty for every trust, not just for the one, not just because it all goes in on like one global report. So it was about £250,000, which I don't think they were expecting.
Expensive phone call.
Yeah. I don't think whoever picked up that phone at the accountants was not a happy chap. But those penalties that I suspect are going to go up, and there's going to be a consultation on ways to help tackle problems arising from the mismatch of overseas interest data provided on a calendar year rather than a UK tax year basis. They say the consultation is seeking to make it easier for taxpayers to declare the correct tax and for HMRC to help them and detect non-compliance. And then there's sort of a general commitment to the OECD measures. So that may seem pretty minimal, but I think there are two really important things in there. One is that we are having this adoption of an international regime of the CARF in a domestic context, which is interesting. One of the things in recent years that has sort of passed us by pretty much has been where we've seen reporting by banks, for example, domestically become much easier for HMRC to get information from banks domestically for their own domestic purposes, and that wasn't really noticed. And I think having CARF as a domestic regime is sort of almost an extension of that approach, but also this idea that we're now going to start ratcheting up the penalties, and I wonder how long it's going to be before we start seeing tax geared penalties potentially. So that's one of the changes. The others relate to, as I've already mentioned, and I'm going to keep it brief because I know we all have to, we've still got lots to get on, relate to changes to the UK's legislation in relation to top up the Pillar 1 and Pillar 2 provisions. So we've got we've got some changes to top-up tax and domestic top-up tax, so a QMDTT. Yeah, QMDTT. That's the first set of measures. Those are going to be effective from the end of this year for accounting periods after the end of this year. And essentially, they just stem from the correct application and making sure that these matters fit within the OECD framework. So those are making changes to Finance Act 2023. Didn't quite make it a year, never mind. So that's the first one. And the other one, I think, relates to Pillar 1. I'm just trying to find it, but if I can't, I'm not going to take you through it because, of course, the thing to remember about Pillar 1 and Pillar 2, it's only relevant to multinational enterprises with a turnover of more than 750 million euros annually. So probably most of us aren't seeing that many companies, clients that are too concerned. So those are that's a quick look at some of the offshore measures that, or sorry, the international changes that we're seeing. And now from the esoteric to the prosaic, or at least from the intangible to the tangible, the most tangible, Mary, you were going to talk to us about SDLT rates.
Yes, so this is a quick one because they didn't do much, but they couldn't just leave SDLT alone. Hard to do. So basically, they're just increasing the current rates that are already there on the purchase of additional dwellings. So that the purchase of a second home, buy-to-let residential properties, or also companies purchasing residential properties. And that is going to be going from 3% to 5%, and that is from tomorrow. So if you've already exchanged your contracts today, then that's fine, you'll be okay. But for everybody else, your additional rate is going up to 5% tomorrow on your additional rate. It's just getting higher. So just another increase. Yeah.
If you look at that additional rate, it already makes tax say on the sort of properties that you anticipate are mostly going to be affected by this. It's making that tax rates in total getting on for somewhere in the region of 20%, isn't it?
Yeah, it's kind of crazy. It's really high. So it's making all this very expensive, but they're doing it. So
it feels high for something which is essentially a transaction tax, right?
Yeah.
There we go.
Yeah.
Okay.
And now I think I'm passing on to Ben to talk about the carried interest rate changes. Oh, Ben, you're muted.
Ben, you're muted.
Oh, no, you're still muted. Can I?
Yeah, I apologise. I apologise.
Ben, I'm really sorry. You unmuted yourself and then I tried to unmute you at the same time and muted you. I'm so sorry. I'm not touching anything. If you unmute yourself,
Yeah,
I'm so sorry.
That's okay.
The level of professionalism, it's immense.
Thanks, Mary. The government will be increasing the CGT rate on carried interest from 28% to 32% from 6 April 2025. And then from 6 April 2026, the government will be introducing a special income tax framework where carried interest will be subject to income tax at rates of up to 48.3%, but subject to certain exemptions. And the exemptions will be subject to consultation with the private equity industry. Leading up to all these proposed changes, there has been a lot of consultation with the private equity industry. And it is unlikely private equity executives or the private equity industry will exit the UK economy. Instead, there will be exemptions that will be brought in consultation with the private equity industry, and it will probably see private equity executives required to invest a lot more of their money in private equity funds in order to obtain concessional CGT treatment and the new carried interest taxation rate of 32%. So those changes will be from 6 April 2026. And I'm delivering
an intermediate position, effectively, where so the government can say, look, we've done something straight away, but then the potentially harsher stuff is we've got a bit of a lead into it, or a lean into it, if you like.
Exactly. Initially the governments, they were promising to crack down on the private equity industry and effectively tax all their carried interest at the highest marginal rate. And because several European regimes offer a similar concession to the private equity industry, they've been forced to back down on that. But that's exactly right, Harriet. For the first year, they will have a slightly increased rate while they figure out how they, if you like, crack down on the private equity industry in a much more limited way.
And so this 48.5%, is that a headline rate or an effective rate?
It's an effective rate. The budget, the autumn budget 2024 refers to a multiplier, I think it is, of 72.3%, something like that. And this is based on a Norwegian tax policy. They effectively apply a multiplier to the carried interest rate. And
okay,
I actually have that slightly, now that I think about it, I have that 48.3% rate slightly wrong. It should be higher than that. It should be slightly higher. I actually applied the rate to 28% instead of 32.
I don't think anyone else would have spotted that, Ben, but very honest of you. I certainly wouldn't.
Yeah. No, that's what it looks like, at least. And I was reading an article on the drawdown, and that this is what they claim. This is their claim, that the multiplier will be applied to the carried interest rate. But I'd also like to just give a brief plug for my seminar. I'm delivering a seminar on the taxation of carried interest for Keyhaven on 14 November. I'll be comprehensively going through these issues and also discussing many planning ideas to mitigate tax. So please look out for that.
Fantastic. So there you go. You've only got a fortnight, barely a fortnight to wait before you can actually get the inside track and some real detail on carried interest. So that's fantastic. Thank you, Ben.
Pleasure. And I'll pass over to Shanzé.
Yes, which takes us back to Shanzé on EBTs and employee ownership trusts.
Yeah, so we've got sort of changes that will take effect as of now, so today, because you had kind of seen there was a consultation, last year into looking into EOTs and EBTs, and maybe there was a little bit of a view that a disposal of shares to an EOT can be exempt from capital gains, and then it was a base, an effective way of business ownership succession arrangements. And I think if any of you came to the Keyhaven seminar earlier, there was a bit of talk about this as well, and how it's kind of a useful tool. So I guess there was some concern that maybe this where it was being kind of abused of the relief that was being provided. So I guess the changes are geared towards making sure that it's focused on rewarding employees and encouraging employee engagement. What that means, there's a bunch of changes. I would just have to go through them one by one.
And so we've got capital gains and inheritance tax amendments. I think that's right, isn't it?
Yeah, I think so.
Okay.
So just going through the changes sort of briefly. So former owners or persons connected with former owners will be prevented from retaining indirect control of a company after its sale to an EOT by virtue of control, whether that's direct or indirect, of the EOT itself. Then the trustees of an EOT, they must be UK resident at the time of the disposal to the EOT, and then need to remain so thereafter. Then any contributions that are made by a company to an EOT to allow it to repay the former owners for their shares will not be charged to income tax as a distribution, and this will be put on a statutory footing so that the clearance request to HMRC is sort of no longer required in this kind of technical point. The EOT income tax-free bonus provisions will be eased, so to allow bonuses to be rewarded to employees without directors needing to be included. So I guess, again, you're seeing like this sort of push of making them, better for employees. And then there's an extension of the relief clawback period.
I would just drop in there, Shanzé, that directors are for tax purposes.
Oh yeah, of course,
employees,
also employees,
which is not a digging you, but it's sort of
sorry, not to mean
But
to
this idea
include
that
any
there are,
directors.
that working people only means a very small sector of people who actually work.
Yeah.
But yes, go on. Sorry,
Um,
I shouldn't interrupt you.
No, that's a very good point. So also extend the period within which the relief can be withdrawn from the former owner if the EOT conditions are breached post disposal to the end of the 4th tax year following the tax year of disposal. I think that requires a bit of a breakdown when it's being applied. And then it needs to require that the trustees must, take reasonable steps to ensure that the considerable paid to acquire the company shares does not exceed market value. Then also there's a requirement that individuals provide with their claim for capital gains tax relief information on the sale proceeds and the number of employees of the company at the time of the disposal. There's also confirmation, they've said in legislation, that restrictions on connected persons benefiting from an employee benefit trust must apply for the lifetime of the trust. And to only allow the IHT exemption where the shares have been held for 2 years prior to the settlement of the employee benefit trust. And lastly, there will be a requirement that will be introduced that no more than 25% of the employees who are able to receive income payments from an EBT should be connected to the participators of the company. So I guess there's a bunch of changes there, and as they're kind of being taking effect from as of now, if this is something that people are keen to have already done, then yeah, I think it requires a little bit of looking into.
Yeah, you're probably too late if you haven't done anything at all. But I think there are certain things that you probably, from my understanding of it, and again, it is a very brief understanding, that you could do, which could assist you going forward, because you can, as I understand it, you can go in and out of meeting these conditions. It can happen that you fall out and then you fall back in again, and that's not necessarily prohibited. I mean, these are sets of provisions that have been subject to pretty egregious abuse over the years. A lot of the Baxendale Walker EBTs were obviously designed to fit within certainly the Inheritance Tax Act regime. So it is understandable that these are now that the government is looking to sort of narrow down what's really going to qualify. And so, yeah, I as you say, this was pretty well trailed prior to the budget.
Yeah.
So yes, but a whole raft of things that people just need to be careful with there. So thank you very much, Shanzé, unless you've got anything else on that.
No, I think it's now VAT, which is also an expected change, and Shane's gonna speak on that one.
Yeah, so thanks very much. This is something that's also been highlighted for some time. So from the 1st of January of next year, all education services and vocational training provided by a private school will be subject to VAT at the standard rate of 20%. It'll also apply to boarding services provided by private schools. And then there's forestalling legislation in the draft as well, which covers any fees that were paid in advance from the 29th of July relating to terms beginning from January 2025 would also be subject.
Do you have any view on a lot of the payment in advance schemes that might have been affected prior to the 29th of July?
Well, I think and this is it's a good sort of segue into we did hold a seminar on this very topic a couple of weeks ago, which I believe it's on our website.
It should be on our YouTube channel, I think. Yeah, that's absolutely right.
Yes, which goes into sort of the different variations in that and which ones would fall foul of the particular planning or not. So also the other item that they put into the draft legislation is that the government will support any time that local authorities need to fund places in private schools for the purpose of special education needs, there will be provision to allow those schools, or sorry, those local authorities to recoup that VAT that they're charged on those public fees. So there's been quite a lot of, I suppose, uproar around the special education impact that this imposition of fees would have. But yeah, and also I did note that they have the government have also flagged that they intend to provide additional funding for special education needs. So it's part of the overall that they think, you know, the charging VAT on these on private education, that money should be used in order to bring all schools up. How that works in practice.
There's no actual requirement on the government to use it for that, is there?
No, exactly.
I mean, as far as I'm aware, I've heard them go on about it a lot, and
yes,
there seems to be this implication or an inference we're all supposed to draw that the money is going to be used for that. But I mean, there are still some people out there who think that their national insurance contributions go to fund the state pension. So yes.
Exactly, and I don't believe they have that granularity either when they collect VAT to be able to allocate that money somewhere, even if they did intend to do that.
Yeah, it's not ring fenced. Yes, to be fair, it would probably be pretty difficult to do that.
Yeah, and alongside the VAT changes, the government also announced that schools in England with charitable status would lose their eligibility for business rates charitable relief, and that comes in from April 2025. So yeah, there'll be a fair amount of activity for the private school sector for those that haven't actually already tackled this or looked into this issue already.
And so I think, and that brings us to the big one. Now, obviously, we all work in a place where non-domicile taxation is a lot of what we do. But this is a big one in every sense of the word. The draft provisions are big. There's 130 pages of them. It's been, I think, one of as I was saying to somebody earlier today before the budget, I was like, it's been like that last week at school before Christmas. Everybody's waiting for the budget and everyone's like a bit nervous and a bit. It is genuinely a huge change, and particularly in relation to inheritance tax, because with inheritance tax, what they're doing is they're completely changing the basis of a tax. And that is a massive thing. So this is a big one all round. We are on to the taxation of non-UK domiciles, and I think it's fair to say that we're all approaching this at this time with a little bit of trepidation. And I've just realised that the only person who's got a visible window is Mary, who is not in the UK. So I promise it is the evening for most of us. I promise. It wasn't a lie. Mary, however, is cheating. She's got a whole day to get to grips with this. But yeah, so talking about this just on the evening after the budget, we don't have the granularity that we would like, but we think it's important to highlight some of the interesting points sooner rather than later. So Mary, talk to us about the remittance basis.
Yeah, so we're going to be splitting this up between all of us. We're all going to be talking about sort of small parts of it. And as Harriet's noted, the legislation is long, and I have skimmed it, but I have not been able to read it in the depth where I profess to know every single thing about it. So I'm going to be providing a brief summary on sort of the first point, which has to be made, is obviously if a new regime is coming in, an old regime has to be dealt with. And so that is the remittance basis, which is being reformed / sort of gotten rid of going forward, but it's not completely irrelevant forever. So just bear that in mind. So we have some draft legislation which is amending the remittance basis so that's no longer available for income and gains which are made after the 2024-2025 tax year. So this means that the last year that anyone would be able to claim it is this year, 2024-2025. Any foreign income and gains that have arisen to a remittance basis user before the 6th of April 2025 will, however, continue to be taxed at the prevailing rates if it is remitted on or after 6th of April 2025, subject to the temporary repatriation facilities. So obviously that means the meaning of a remittance is still going to be important going forwards. And to that end, there have been changes to the definition of a remittance based on the fact that there was a recent upper tribunal decision saying that the definitions weren't very good. So as a result, the government has expanded the meaning of remitted to the United Kingdom. And the main way they have done this is by clarifying in almost every section that where property is used outside of the United Kingdom with the result that a benefit is enjoyed inside of the United Kingdom by a relevant person, then that property is considered remitted. So just bear that in mind, and bear in mind that this definition has been expanded. Now, outside of limiting the remittance basis, the legislation is going to be updated more generally to get rid of domicile as a tax concept. Now, outside of our obvious changes, so removing it more generally by getting rid of, for example, the remittance basis or its relevance in inheritance tax, the meaning of domicile does have relevance to other aspects of the tax legislation, so it will now be removed for that as well. So this includes when considering the residence of the trustees of a settlement created on or after 6th of April 2025 in the residence of personal representatives. So this is just to say, obviously, there's the obvious ways we know the domicile is important, but it's also important for sort of minor points too that can come up. So you'll just want to double check the legislation when you're looking at these sorts of things to, if in case domicile may have been relevant before and no longer is. So to that, I think I'm now passing on to Ben, who's going to talk about the rebasing of assets going forwards.
You're muted again, Ben. One of only a few of us who's good-mannered enough to do it.
So from remittance basis users, they will have the option of rebasing their foreign assets held at 5 April 2017 to their market value at 5 April 2017 for CGT purposes if they desire. Effectively, they can choose whether to take the value of that asset at the market value of that asset at 5 April 2017 or the value that it has now, whichever is more favourable to them. And I pass over to.
So sorry, that sounds like the simplest bit of all of this all of this legislative mess.
It's short and sweet. It's
fantastic.
It's as simple
That's what
as
we
that.
like to hear.
Yeah, it's as simple as that. Assets can be rebased for CGT purposes. Assets that were held at 5 April 2017 can be rebased to their market value at 5 April 2017 for CGT purposes if the taxpayer desires. They also have the alternative of not rebasing. They can just take the it may be that the base cost of that asset is higher than the market value at 5 April 2017. That would be the case if the value fell between when they bought it and 5 April 2017. But that particular measure is fairly straightforward. And I will pass over to Shane, who will discuss relief non-domiciled individuals and relief for new residents.
Thanks, Ben.
Presumably you're now going to tell us that that's dead straightforward as well.
Yeah, exactly. Another straightforward change. No, unfortunately, there's quite a bit of detail that we've been provided. I've just seen sort of some draft legislation, but I suppose the headline is for qualifying new residents. They'll have their foreign income and gains arising during the 4-year period relieved from tax. And their tax treatment will no longer be based on their domicile. So I suppose it leads to the question then, who is a qualifying new resident? So in effect, it is an individual. So the individual is UK resident for the tax year. The individual is not disqualified for that tax year. And for each of the 10 tax years before that tax year, the individual was not UK resident. So quite a long lead time. You know, you would have to have been away for a long time or be a total newcomer into the country really to come within that definition. And then
I mean, it seems clear that there are going to be very few people who were already within, well, there will be very few people who have already decided to base themselves in the UK in the medium term who will be able to benefit from that even for a short period of time.
Yeah, and I think also it's for people who maybe through planning have left the UK for a period of time and intended to come back, that you know, they're in effect excluded really from some of the benefits under this the new rules. Yeah, and an individual could also be a qualifying new resident if they are a UK resident for the tax year and they're not disqualified, and the tax year is one of the next 3 tax years after a qualifying tax year in relation to the individual. So that seems to just broaden out when you can start your particular time for applying for that particular relief. But again, I don't really have much more to say on it. There is quite a bit of legislation which we'll need to sort of go through and look at, and as Harriet mentioned, no doubt this will be subject of another more detailed presentation or otherwise from Chambers.
At some point, I've no doubt it will be. So I think one of the things that I noticed today that was said about this is, oh, this is a competitive regime internationally. And I have to confess, while you've been speaking, Shane, I've just been looking to see if I can find anything about the competitiveness of it. And what I've found is something from Dominic Lawrence at Charles Russell Speechley from last month. And he just mentions 2 regimes that are probably better. So one being the Swiss forfait regime, which is of unlimited duration. And then there's apparently a flat tax regime in Italy, which is for 15 years. So ours seems desperately uncompetitive, if I can put it that way. And so I've not seen anything. I've heard it said, oh, it is competitive. I've not seen anything to back that up particularly. And obviously, it may be that there are only the Swiss and the Italian regime that are gentler, but I suspect that isn't the case.
It may well compete. It doesn't mean it's going to win. So
that's a very good point. Yes. Yes, I suppose I could line up against Usain Bolt and I'd be competing, wouldn't I?
Can I just jump in on that point?
Of course.
Yeah. With the Swiss regime, it is indefinite, but you can't work in Switzerland. Most of the other European regimes are more competitive than the UK's, and most of the European regimes that do have something similar to a non-domiciled regime. So Italy has a lump sum taxation regime. I know, or Shane would know a lot more about this than me. I know Ireland has a non-domiciliary regime, but those regimes do extend for a much longer period of time than the UK's regime.
Outside of the UK, I'm thinking of Israel, where I think certain incomers get 10 years almost tax-free. And Ireland, I think I'm right, Shane, in saying has a regime that is very similar to the one that the UK had pre the 2008 reforms, which was better, better for the taxpayer. So yeah, yes. So we should probably crack on, because I know Mary has to go. So it's on to me to talk about PAYE on foreign employment income. So I think this is quite complicated. I don't know if anybody else has had time to read it, but I think it's quite complicated and I don't love it. So just let me find my notes on this. One moment. I'm so sorry. I've now lost my place. I'm letting everybody down. Oh no. So this is a simplification in effect. At the moment, when an employer makes an application to treat only a proportion of income paid to an employee as PAYE income, you can't act on that until you have had approval from HMRC. So you can't sort of apply and say, this is what I'm doing. You have to apply and wait for them to say, okay. However, from the 6th of April 2025, it's a simple notification process so that there can be an exclusion of a proportion of a qualifying employee's relevant pay from PAYE. And then from that time of the notification, you can only operate PAYE on the earnings that relate to work in the UK. This ties in with the non-dom changes because there are some fairly extensive amendments to the overseas work rule. And so this ties in with that overseas work rule change as well. And the only thing to remember on that is that where you have the notification process as opposed to the approval process, you might be told you've got to make up tax that you should have paid if HMRC don't agree with the accuracy of your notification. But a slight simplification to go with the OWR changes there, just dealing with that one very briefly. And it's back to Shane, who is hopefully going to tell us about the repatriation facility. Is it good? Does this make it a more competitive offering?
It's yeah, we're catching up. We're not quite there, but we're catching up. So I think this, you know, a lot of this is sort of was flagged by Mary Ashley earlier on, where she was saying that you know, that we're changing the remittance basis. So the new temporary repatriation facility will be available for people who previously claimed the remittance basis. So this will be sort of some sort of some relief that is exactly transition provisions. It's getting late in my day. I've had an early start. It's my story and I'm sticking to it. So the individuals will be able to designate and remit at a reduced rate foreign income and gains that arose prior to the changes. They are also modifying or simplifying. They say simplifying the mixed fund rules. I'll reserve my position on that until I've had a chance to read through it in detail. But that's
probably wise. I always try to reserve my position on the mixed fund rules anyway.
And the temporary repatriation facility rate will be 12% for the first 2 years, and then 15% in the final year of operation. So it's to try and encourage people to bring money in who have been using the remittance basis to date.
So effectively remit now at a reduced rate.
Basically, yeah.
Yeah. Okay. So it's getting us a bit of the way there. And then it's back to me again to talk about some of the broader changes that go with the changes to the non-dom regime. So some of these, I'm going to talk about a couple of things, in particular, the settler interested trusts regime and the transfer of assets abroad regime, but also about changes to the treatment of settlements, which go hand in hand with the non-dom changes, but are unfortunately complicated in their own right, which I'm sure is what everybody wanted to hear at 9 o'clock at night. So first of all, starting with settlements, and this is trust protection, effectively, to begin with. Now, going back a few years now, but not that many years, even in tax terms, when there were the last set of sort of major or semi-major changes to the taxation of non-UK domiciliaries, we ended up with the protected trusts regime, which, if people recall, was sort of the sweetener for the loss of remittance basis for people who became deemed domicile after 15 out of 20 years, or by means of being a formally domiciled resident. So not the formerly domiciled resident, because it didn't apply to them, did it? So this regime is going to go. We've had it about 6 years, I think, which is a bit depressing, with effect from the 6th of April 2025. Trust protection no longer applies. It's not going to apply in relation to settlor interested trusts. It's not going to apply in any of the other ways it did either. So from the 6th of April 2025, foreign income and gains arising in a trust, whenever it was established, so it applies to old trusts as well as new trusts, is going to be taxed on the settlor on the same basis as UK domicile settlors, unless they're within the new 4-year FIG regime. Now, so to pause there, we are going to have settlements which had one treatment until 2018, one treatment for this 6-year period, and then has a third treatment thereafter. So while I don't think you can fairly say that it's retrospective simply because it applies to existing trusts. There might have been some common sense approach involved in not changing to a third regime, but we are changing to a third regime, so that's where we are, unfortunately. So turning then to the settlements legislation, and just a quick reminder for anyone who maybe doesn't know, the settlements legislation is EOTs section 620 onwards, and it taxes trustees. Sorry, it taxes settlors where they retain an interest in a broad sense in the settlement. So from 6th of April next year, you're not going to get any trust protection in that respect. And that means that from that date, all income arising under the settlement will be taxed on the settlor as it arises, where they or their spouse has retained an interest in the settlement. Income is provided to or applied for the benefit of the settlor's relevant children, or the capital sum conditions are met. So that's the headline. Basically, you're back to the basic regime there. In terms of consequentially, what's going to happen is there's going to be removed this concept of tainting. So again, if you're familiar with the protected trusts regime, you will know that a trust and the income gains, etc., within it was only protected to the extent that it wasn't tainted, and this was that a settlor had not added value after the relevant date. That concept is going. And then there's a sort of a slightly complicated matching situation, which ensures that the benefit charge only applies to UK resident settlors to the extent that any benefits they receive after the 5th of April 2025 are matched with PFSI or TTI that arose before 6th of April 2025. PFSI is protected foreign source income, TTI is, I think, transitional trust income. So that's essentially income that wasn't charged because it was within this regime. There's now a matching regime for that. So brilliant. We then get the modification of the close family member rules, which just removes references to the remittance basis and amends them to include a charge on UK resident settlers outside of the FIG regime, where a close family member receives a benefit but is not taxable because they are eligible for and have claimed the 4-year FIG regime. So essentially this is saying where you sort of get around this by paying income to somebody who can't be charged on it, we're going to charge it on this as if it was income of the settlor under the settlements legislation. So again, we have comparable type provisions to this, but it's just another layer of complexity, which we could have done without, and I think certainly taxpayers could have done without. We've got modifications to the onward gift rules to remove reference to remittance basis payers, and also a similar amendment to the one I've just mentioned, whereby if you've got a taxpayer who is within the FIG regime, then it's going to be chargeable elsewhere. So again, it's not something that's an unfamiliar concept, but it's another layer of complexity. And then we have one of my favourite types of provision that we get, the technical document says from 6th of April, where there are multiple settlors potentially liable for tax on the income arising under the settlement, HMRC will have the ability to apply and apportion the tax charge on a just and reasonable basis to prevent any potential double taxation. There will be a right of appeal against such decision, and any such appeal must be made in writing in the usual way. So there's an existing provision like that. Well, there are several, but the one I'm most familiar with is the one in the transfer of assets abroad regime. Within that regime, where more than one person could be charged, HMRC can pick on a just and reasonable basis. I think these provisions are a very obvious example of people not wanting to put a calculation in and just going, it's too hard, let's leave that to somebody else. In my experience, inevitably, when HMRC have to exercise this power, the taxpayer never feels that the basis is just and reasonable. So they tend to be difficult provisions to deal with. So I'm not sure that was the best way to deal with this, but I do understand why an alternative wasn't chosen. The other thing that I was going to talk about was the transfer of assets abroad regime. We've got, in relation to trust protections, broadly similar changes there. And I'm talking about this all very airily. This is pages and pages and pages of the draft legislation. So it is going to be immensely complicated, but they're seeking to make similar changes there. But really interestingly, in the technical document at paragraph 66, there's this little throwaway line. With effect from 6th of April 2025, individuals will no longer be able to claim an exemption from charge under TOAA on the basis that their EU treaty freedoms have been infringed. And in the technical document, there's no more details. And I dug through the legislation and I can't find where that is in the legislation, if indeed it is in this legislation. I don't know if anybody else has dug that out yet. But in any event, it's a really interesting idea, because are we restricting freedoms from pre-EU, pre-Brexit situations? It's interesting. So I've got to dig that out a bit more, but you can guarantee that I'll have more to say about that when I've worked out where I am with it. It's possible that it's being trailed somewhere else and I haven't caught it, but that's where we are. And so I am going to hand over to Mary, who is going to talk really quickly about the IHT changes because she's got to get going. Mary.
Yes, and to be fair, I think to do the IHT changes justice, because I think, as Harriet pointed out at the start, it's a complete fundamental overhaul of how inheritance tax is applied for the past forever. Really does require more than just a summary, but that's all I can really do right now. The other nice thing is we've had an indication of what this was going to be for quite a while, so there's already been multiple talks over kind of what to expect out of these changes, and for the most part, they're kind of in line with what we were expecting to have happen. So in terms of UK assets, obviously there's no change there. They were in the scope regardless of domicile, so they're in the scope regardless of residence. The bigger question arises now in relation to non-UK assets, because before, based on your domicile, they would either be inside or outside of your estate, but now it's not going to be based on your domicile, but rather based on your residence. So the test for whether non-UK assets from 6 April 2025 would be within the scope of UK IHT will depend upon whether the long-term UK resident test is met. The long-term UK residence test is met if you have been resident in the UK for at least 10 out of the last 20 years immediately preceding the tax year in which the chargeable event arises. So whether that's a sort of a chargeable event because of death or a chargeable event because of a trust-related chargeable event, then that is going to have to be the test that has to be satisfied. Now, a person can get out of this if they leave the UK, but they have to be outside of the UK for a certain amount of time before they are then outside of the UK inheritance tax net. And how long you need to be outside of the UK depends upon how long you've been resident in the UK. So if it's between 10 to 13 years, then you only have to be non-UK resident for 3 years, but then it goes up a year after that. And the test will apply regardless of an individual's common law domicile. So I suppose that opens up new opportunities for UK domiciled individuals who become non-resident. So that's something to think about going forwards. And so going forwards, where the assets are owned outright, which is how the majority of people own their assets, then inheritance tax is charged on the assets if the person is a long-term resident. And this can be compared and contrasted with the position where obviously you have a settlement. Now, this was the more interesting information we got out of the consultation, which helps us to learn a little bit more about the excluded property trust treatment going forwards. Now, as of 6 April 2025, the excluded property trust status of non-UK settled assets will not be fixed at the time that the assets are added to the settlement, but instead it will depend upon whether the settler is currently long-term resident. I think this kind of reminds me a bit more of the formerly domiciled residence rules and how they kind of use that to test whether or not the assets would be excluded or non-excluded relevant property. Inheritance tax will be charged on non-UK assets comprised in a settlement at times when the settler is a long-term resident. So that means they will come in and out of charge alongside the settler's residence. So as that changes, the status will change. If the settler dies on or after the 6th of April 2025, then obviously the future status of the trust will be relevant for the beneficiaries. And so far it says the excluded property status going forwards will depend upon the settler's long-term residence status at the time of their death. And I think the other point to make is that when a settler ceases to satisfy the long-term residence test, which means that relevant property will then become excluded property, then there will be an exit charge. So that is what they're saying so far, and bear that in mind. And I also noticed in the consultation they made some points about the gifts with reservation of benefit provisions. On the whole, they're not changing all that much, but you're just going to want to bear those rules in mind if they could be applicable to a client who is changing into a long-term resident. As I said, this is very brief. It does not cover everything. The legislation is long, but it gives you an idea, and I'm sure we will have a future talk actually discussing the rules in fuller detail.
I think you can bet we will. Mary, thank you so much. And Ben, over to you to take us home with transitional reliefs and commencement. You're on mute again, Ben, sorry.
Okay, sorry.
Don't worry, you're fine.
In terms of transitional reliefs, we've discussed the temporary repatriation facility. That's probably the big one. But other overseas work relief will be extended to 4 years to align overseas workday relief with the 4-year time limit for the foreign income and gains regime. And this is similar to Spring Budget 2024. The removal of the remittance regime means that there is no need to keep overseas workday relief income overseas to obtain this exemption. There will be a limit on overseas workday relief. It will be limited to the hire of £300,000 or 30% of a taxpayer's employment income for a particular year. Individuals won't be able to claim income tax relief on chargeable overseas earnings from 6 April 2025. This was a separate relief for individuals who didn't qualify for overseas workday relief but earned employment income, and they claimed this relief in respect of foreign employment income where the work was wholly carried out abroad. Those earnings will continue to be eligible for the temporary repatriation facility. And we've discussed the temporary repatriation facility above. Essentially, it's available for the first 3 years, and an individual can remit overseas employment income to the UK and obtain a rate of 12% for the first 2 years and 15% for the third year. And then the exemption for payment of travel the exemption for payment of travel expenses for non-domiciled individuals who come to the UK. This was available for the first 5 years. That has now been reduced to the first 4 years. So for a new resident coming to the UK, they're able to claim they're able to claim an exemption on reimbursement of any travel expenses for the first 4 years of their residence in the UK. And just in relation to transitional reliefs, I would note that the government has dispensed with the proposal in Spring Budget 2024 to exempt 50% of income brought to the UK, 50% of foreign income or gains brought to the UK in the first year by an individual, a previously non-domiciled individual. So that concession will not be available. And that broadly covers the transitional reliefs available to non-domiciled individuals.
So thank you, that's fantastic, and thank you all for your time. An awful lot of interesting stuff there, and an awful lot for us to get our teeth into, and that's even before we've started to spot the detail of it. So we hope this has been a useful introduction, a useful summary of Autumn Budget 2024. As we've already said, we're not through to the bottom of this yet, but we hope we've been able to give you a bit of an inside track. Thank you for watching, and look out for our future seminars, webinars, and other tax snacks on some of the topics raised.